What's up everybody, I am Jasprit Singh from theminoritymindset.com and welcome to The Minority Mindset. Financial planning is one of those things that we're all expected to know how to do, even though most of us are never taught how. Well, maybe if you had financially savvy parents, they told you to save a little bit of money, and maybe if you're up for it, invest a little bit of money too. The problem is, if you don't give your money a plan, then your money will leave. Money, where'd you go? Come out, wherever you are. The majority of people have a three-part financial plan that looks something like this. They make money, and then they spend money, and then they wonder where all their money went. Okay, money, you can come back now, but it doesn't have to be like that. Look, if you can order Chipotle with extra guac and get it delivered to your doorstep without ever leaving your sofa, then you can come up with a budget that will help you build your wealth. You just want to make sure that your budget sets you up for building wealth instead of just getting by, because there's a big difference between these two types of budgeting, and that's what I'm going to be talking about in this video. But before we get into that, hit that thumbs up button below, because if you don't, then YouTube doesn't share our video with anybody else. Subscribe to the Minority Mindset YouTube channel, that way you don't miss our new financial education videos every single week, and hit the little notification bell too, because if you don't, then YouTube won't let you know when any of our new financial news and education videos are released. The first thing you need to do is figure out where all your money is going. Money, where? Oh, there you are. Why do you keep hiding from me? This is the part that nobody likes doing, because you're gonna have to talk with yourself about your spending habits. What did I tell you about paying $700 for scarves? It's almost like when you were in high school and then your teacher would pass back your test results and you would see that, oh my God, you were so close to an A, but you had made 15 careless mistakes. Maybe that was just me, but you have to do the same thing now with your money, except you have to be the one that grades yourself. We're gonna do this the old school way, so I want you to clean off your kitchen counter and bust out your bank statements, your payroll statements, and your credit card statements. Now, write down how much money you made last month, and then write down where all of your money went. So write all of your expenses, and write how much money you saved and how much money you invested. Wow. Before you can make a plan on what to do with your money, you need to know where all your money is going. So guac is really extra, huh? Hopefully looking at your money is going to be the inspiration that you need to go out and make a better plan with your money, because that's exactly what we're going to do now. An average financial plan does two things. It tells you how much money you can spend, and it tells you how much money you should save. A good financial plan does three things. It tells you how much money you can spend, it tells you how much money you need to invest, and it tells you how much money you need to save. A great financial plan automates your good financial plan. You got to come up with the best ratio of spending, investing, and saving for you, or you can follow our 75-15-10 or 50-30-20 plans. If you are older and you have financial responsibilities, you can follow our 75-15-10 plan, which says that for every dollar that you earn, you can spend a maximum of 75 cents, you should be investing a minimum of 15 cents, and you should be saving a minimum of 10 cents. If you are younger and you don't have financial responsibilities, this is your time to double down and build your wealth, so you can follow our 50-30-20 plan, which says that for every dollar that you earn, you can spend a maximum of 50 cents, you should be investing a minimum of 30 cents, and you should be saving a minimum of 20 cents. The easiest way to force yourself to stick with your plan is to automate it and create 2 or 3 different bank accounts. One bank account is going to be your checking account. This is the money that you can spend. One bank account is your savings account. This is your money that you're saving for emergencies. And one bank account could be for your investment money. I say that one bank account could be for your investment money because it depends on your financial goals. Some of you might just want to be very passive investors, where every month a percentage of your paycheck is automatically invested for you and you don't want to be hands-on with your money. If that's you, then you don't need a separate bank account for your investment money, because this money can automatically be withdrawn from your checking account and just go straight to your investment account. If you want to be more active with your investments and you want to pick and choose what your investments are, then it helps to have a third bank account where you take the cash that you want to invest and put it into this bank account. That way you can easily see how much cash you have waiting to be invested. The reason it helps to have a different bank account for your spending money and your saving money and your investment money is because you don't want to accidentally spend your investment money on a new TV. Your spending account has all the money that you're allowed to spend. So this is the money you can spend on your rent, your mortgage, your groceries, charity, and everything else. Once the spending money is gone, you're not allowed to spend any more money. That's it. You got to know how to live below your means. Your investment money is the money that you're using to build your wealth faster. You can use your investment money to pay down your debt faster. You can use it to buy stocks or real estate or start your own business. The main thing with your investment money is this money needs to be used to buy assets, which are things that pay you. You do not want to use your investment money to buy liabilities, which are things that just take money away from you. And your saving money is your emergency cushion. This is the money that you can tap into if you run into a tragedy or if you lose your job. This is the cash that you have to protect you from these emergencies. But here's the catch. You don't want to just save save your money just to save it forever, okay? Your savings are losing value to inflation, so you want to be thinking bigger. Once you have 6 months worth of expenses saved for an emergency, this is not money that you're saving for a down payment on a home or something else. This is just cash you're saving for an emergency. Once you have 6 months of these expenses saved, now you want to start thinking about reallocating the saving money either to your investment or maybe a little bit to your spending money too. I don't want to go too deep into the details of how to use your money in this video because I want to focus in on the budgeting part. But if you do want to learn more about money management and investing, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails, which are also free. You can get a free ebook and start reading our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are separate from our financial news emails. Making a budget is the easy part. The hard part is sticking with it. Thankfully, we're in a digital age and you can turn your good budget into a great budget by automating this whole process. If you know that $5,000 are coming into your bank account every single month, then you can create automatic transfers that move 15% of this $5,000 or $750 into your investment account, and you can move 10% of this $5,000 or $500 into your savings account automatically. Now, you're putting your money to work in the right places before you even get a chance to spend it. Now, when it comes to spending, you are forced to live below your means because you have less cash left over in your spending account. Your savings are slowly building you a cushion, that way you have something to fall back on in case an emergency happens. And for your investments, well, this is where you need to know yourself and your risk tolerance. The most risk-free way to invest your money is to pay down your debt faster, because if you're paying 6% a year in interest on your student loans and you pay off your student loans a year early, well, you just got a guaranteed 6% return on your money, because that's 6% in interest that you don't have to pay to your bank. If you want to be more of an active investor, but you don't really want to go into the details of analyzing companies and stocks, then you can look into investing in index funds. You can think of an index fund kind of like a group of stocks. When you go out and you invest in individual companies or stocks, there's a risk that the company that you invest in is going to go bankrupt. And if that happens, your investment is going to go to zero and your investment money is going to be gone. But if you invest in index funds, now you're not investing in individual companies, you're investing in a fund that invests in a whole bunch of companies. Now, even if one company goes bankrupt, you're okay because there's a lot of other companies in the fund to balance that one bad company out. So this is your lower risk way to invest your money into the stock market, because now you're not investing in an individual company, you can get exposure to the entire stock market as a whole. If you want to be even more involved with your investments, then you can look at investing into individual companies, or my favorite, investing in real estate. This takes more time and effort on your part, because if you want to invest in individual companies, you got to be doing your research to make sure this company is growing and it's a good stock. And if you want to invest in real estate successfully, you got to build a team, you got to know the location, and you got to make sure your tenants are paying rent. Being more active with your investments comes with more risk, but it also comes with more potential return. Look, investing is not a guaranteed thing, okay? You are never guaranteed to make money when you invest. You might even lose money, which is why you have to do your own due diligence, and it's why you want to never blindly listen to a random guy on YouTube. But now you're building a financially healthy lifestyle, that way you can live a wealthy life. It's not easy and it's not a quick overnight thing, but it will work if you stick with it and you work for it. Thank you for watching. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about the downfalls of saving too much money, I already made a video on this, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.